Hi, everyone. Welcome to the Dr. Laurie Davis Show here on E360 TV and Tuesday Money Matters with our guest host, Ramin Modiri. I hope you've been catching the shows after hours because they have been really fun. I believe a lot of us might have an attitude that finance is not fun. Finance is always negative and heavy and hard and whatever. But Ramin brings that nice spark to it so that we can make it a fun thing. How are you today, Ramin? Welcome to the show.
Oh, thank you so much. It's great. It's Tuesday. I'm excited. I'm so happy to be here.
Great, great. Well, this is our fourth show together. And the first two I really enjoyed. You talked about financial biases. I really love that. And last week, if you've missed the show, Ramin talked about 10 favorite movies that involve money. So we have that list as well. But for today, you have something a little more fun for us and a topic that I know very little about. So I'm going to got my trusty notebook here. And when you're listening to the show on Tuesdays, you need to have your notebooks because there's so much. We're streaming live on E360 TV right now. YouTube channel, Laurie Davis Show Host is what you search for. And also on our Facebook streaming page, Self Worth the Missing Link Superstars. So I have that because everybody that comes on the show is a superstar. Sometimes they realize it and sometimes they don't. But we support that. So over to you, superstar, to talk about the stock market. I can't wait to hear what you're going to say about that. Over to you.
Thank you. Yeah, I thought again the subject I like to choose for our shows. Um, Hoping it's lighthearted, but also has a point, and it gets to the depth of the matters. And I know a lot of people obviously have been interested in the stock market, especially in the United States and North America. There's a lot of interest. So I thought let's bring some fun facts about stock markets and investing and why this thing we are so fascinated by it, and why there's sometimes when you go to a weekend parties that becomes a subject of interest, especially when people have really good success. They talk a lot about it. When there is hardship, nobody really wants to say about their failures. All of a sudden there's like a silence. So that's one of the ways I know from sentimental side of things, knowing that the markets are really topping when everybody is bloating and gloating about their how much money they've been making in the stock market or the real estate or anything to do with investments. And I know, you know what, gotta put our brakes on. Something is happening. I've said it before, when you're somebody in your taxi driver or your beautician, they give you hints about where to buy the real estate or what stock to buy, then it's time to leave. So anyway, so I thought today we'll talk about this fascinating story about stock market and especially why it's important in the United States. And so there will be more of a trivia. So I hope you'll enjoy it. The first thing about United States. So when you go around the world, everybody talks about how the markets did, and the number one thing is they compare it to United States stock market. So the biggest index or the most important index that everybody follows, and it's almost your goalpost, right? So you want to compare, oh, what is my stock is doing or what my portfolio is doing? If they compare it to S&P 500. And what S&P 500 stands for is Standard Poor's, which is an organization, 500, which is the top 500 companies. Now, when we talk about that, these are actually chosen. So there's not really transparency, even though we think, oh, there's a 500. The Standard Poor behind closed doors decides to choose, well, for to 2023, these are our top 500s, which is based on their market value. And market value is basically what that means is the number of shares that you have times the value of that stock or the value of those shares. So the higher the price and the more number of shares, the bigger the company. But you will notice that sometimes in June, in December, they decide to switch. Maybe one company is not doing as well, so they decide to get rid of them. But S&P 500 is your goalpost, and it is the index that a lot of portfolio managers and they all compare it to that. And the reason is because they are some of the largest companies in the world. And again, United States being the largest. And the reason, again, they respect this, because believe it or not, the US stock market is 46% of the world stock capitalization.
Wow.
That's almost half.
Wow.
And that's the reason there's a lot of respect and a lot of comparisons. A lot of overseas portfolio managers or international, they usually have part of their investments in the United States. So that's number one. So that tells you why it is important to follow the US markets. The other reason is, if I think about United States stock market, it is more than the total of the next 7 stock markets put together. So when you look
Oh,
at
wow.
all the other sevens, whether it's the DAX or FTSE or what we're talking about, let's say Japan, look at Germany, UK. If you put all 7 of them, US market is bigger than that. So
Wow.
that's another reason it's important to follow the US market. There's an old saying, and it still applies, because we did have the 2008, for instance, uh, obviously the financial crisis. There's an old saying is that when United States market sneeze, the world catches cold. So that's a barometer.
I
So
like that.
when we had like 19, the 2000, 2001 internet bubble, these things, or we had a Great Depression in the United States, it affects the whole global markets. So again, when we sneeze or US sneezes, the world catches cold. So they
I
follow
like
that.
that.
So then, because the markets are basically built on the stocks, individual companies, now you see the power of these companies. Like company like Microsoft, just by itself, when we think about the value of Microsoft, it is bigger than Brazilian stock market. So you can either stock and invest in Microsoft or go to Brazil. So,
I see.
and Brazil is the largest. It's like, besides, we have China, India, and Brazil. They're the large emerging markets. So Brazil is a very large market, and yet Microsoft is bigger than that. The other part is, like, when you think about Microsoft, I just talked about, or Apple and Google. When we put all 3 of them together, they're actually bigger than the Chinese market. And when you think about, China is the second largest economy in the world. And
Wow.
yet 3 companies combined are bigger than China. And the other interesting thing is, like, Apple stock, which is actually the largest representative in S&P 500, it's the largest market cap. Believe it or not, it's worth more than the GDP of Canada or India. So here you have Apple. Even if you think about India, which is the largest population wise in the world, you have Apple. It has more value than GDP of India, with 1.3 plus billion people producing. And here's Apple. So that tells you, this is the reason there's a fascination with the markets and stock market, because people want to be part of that. And they see that, just buying 1 share or 10 shares or 100 shares, they are part of this prosperity. So I'm going to switch sides and talking about, well, there's a lot of, again, interest in stock market, and we got a lot of professionals, but believe it or not, 82%, which is 4 out of 5 fund managers, these are the professionals, they actually fail to beat the stock market, let's say S&P 500 returns. So if you put your money in just S&P 500 yourself, there's exchange traded funds, and you just said, oh, I just let them invest in those 500 or go hire a professional, 4 out of 5, they would fail. So you would be better off to do it on your own. The good news is, of course, there's 18%, which they will beat. And this is over the 10 years, by the way. I'm looking at the 10 years. So that is the important part as far as that goes. Now, as far as how far we've come from that financial crisis, we have more than quadrupled since 2009 when we really hit the bottom. When you look back, we almost actually 5 times the amount of the world stock market have grown 5 times in past 13, 14 years. So we hit the bottom, and then how fast we just moved up. So that again shows the power of the growth. Um, as I mentioned again, US is bigger than the seven next. So when we think about, there's, as I mentioned, like US is putting all the seven, whether it's London, whether it's Frankfurt, Hong Kong, Tokyo, we are much bigger. So the other exciting part about again, especially innovations, the biggest portion of your money when you're investing, as far as the value of the companies, when you think about the sectors, these are the top four that the most of the companies' value in the world is, more than half of it. So there's a four specific sectors that we'll talk about in industries. One is the information technology. It is a big portion of the valuation. A lot of money goes in there, and it's for a good reason. And of course, our globally we're getting smaller and smaller. So information technology is about 16% of the whole world's value of the markets. So again, that's how big they are. The second part is the financials, and of course, it makes sense. The banking and financial services, they really control, the global economy. So they are almost 16% as well. So information technology, financials, and also communication. That's another big part of the value of the markets, and they are play a big role. And the fourth thing when we think about is the healthcare. So now we got financials, health, technology. You see how three of them go hand in hand, and it's a good marriage. So basically, I would say financials and health get married and have a baby of technology. So because it is innovation. So that's again, that's important to know. What is as far as what's happens as far as evaluation of the different sectors. The power of the markets, and that's another reason again why people are interested in investing, is that the stock markets actually perform very well, especially when it comes to technology. So believe it or not, from the 2002 bottom, which was happened after the internet bubble, and of course we had the 9/11, the whole global. So if somebody was fortunate enough to put their money at the right time, at that time on the bottom, and left it there and put it in a technology. So we talked about S&P 500. There is another index, United States. It's called NASDAQ, which is basically NASDAQ comprised of mostly technology companies and the bigger companies, and excludes a lot of times more of defensive stocks like for instance, utilities and financial. So NASDAQ is very big in technology. If you were lucky enough to do that in 20 years, you would have been up 907, over 900%. That means you would have
What?
900%. So what that means, like 100,000 would have gone to 900 or $1,000,000. So basically, you have $900,000 on your money, and that's the attraction. But also, it's attraction about going long term, and that's why it's important to, when you're investing, you have to make up your mind: is this for a more of a long term, so I can absorb the ebbs and flows and peaks and troughs of the markets? And that's why it's so good for the, especially the younger generation, or people who are younger, to think long term. And that's where the stock market becomes very attractive to them, rather than putting their money in like a savings account. On the other hand, a lot of attraction is into trading, and trading is very short term, which is more of an income producing. So you can go from day to day, make money. But when it comes to investing, that's the reason, again, that's the beauty of investing for a long term. Now, would you guess who, um, what market around the world was the, I mentioned about Nasdaq up 900%, but there's a market which beats Nasdaq for that 20 years, and it was almost double that amount. So if you would have invested in India's stock market at the same time period, you would have been almost 1,800% up. 1,800% in a country that, when you think of this as a developing, emerging country, you would think about infrastructure, but that's a growing, very much technology oriented. That the middle class is really coming in intuition. There's a lot more interest in education. So that would be up actually about 1,792% to be exact, for the 20-year period. In the meantime, interesting thing is, when you think about, okay, all the stock markets are the same, if you would have invested in UK, you would be only up 46%. Gone nowhere. You could have put your money in in a bank account. And so not all the markets are the same. So even Japanese market, and this goes from 2002 to 2022, the Japanese market were only up 172%, which is still not bad, but not 1790 or 1800%. But that's the attraction of, again, investing, especially if you have like retirement accounts. You always want to put a portion of it, and that's how you get around the inflation on top of that. And that's what stock market is, a good tool against inflation. So um, one of the things, as I mentioned, about using indexes like the S&P 500, you can do the technology index, is because only when you individually invest in stocks, only one out of those three stocks can beat the market itself. So the success ratio you have if you randomly decided to do some stocks is 32%. So either you really have to be a good analyst and pick and choose, or it's much better just to invest in an index. So you don't have to do a lot of analysis. So when we think about S&P 500, well, you got the 500 top companies in the almost world, I mean, but in the United States. You can actually invest in China, get their index. You can invest in India. You can invest in healthcare. So this way you don't have to think. But the major ones like a S&P 500, it gives you that 3 to 1, the odds of succeeding, rather than, again, if you just randomly chose a stock, you're going to know that there's a 70% chance that you're not going to beat the market. So that should give an average investor the comfort knowing that, you don't really have to get too sophisticated unless you really want to beat the markets. And as we just discussed it, 82% of the professionals cannot even beat the markets. So, what kind of a
I
chance?
bet you could, though. I bet you could.
I've been
I bet you would.
fortunate. So, the rule number one is not losing. So I've been pretty lucky when, we've had these big drops, like we had the internet bubble and, the financial crisis. I was very fortunate in 2008. We actually were up because I started in 2007. Just goes back when someone that I was working with, and she goes, "Oh, I want to buy this $1 million property in Las Vegas. Do you want to go with it?" I'm like, she's telling me to spend $1 million in a high riser in Vegas. This is something is wrong with the real estate. And then obviously we had the rolls, and what happened affected all aspects of financial crisis. So I started shorting the market. What that means is I kind of decided to go against the market. And I mean, it was my clients, and we kind of protected ourselves. So in 2008, our portfolio was like up 1.6%, not sexy, it was not, but the markets were down 38.5%. And it took a lot of investors, and that's the negative side. And that's the reason we talked about biases and sentiment, that unfortunately, when we get hit hard, we have that memory for a long time. So we talked about the snake bite, right? We don't want to get back in. So even though I just mentioned to you about 2002 bottom, how many people really had the courage to get into the market? They usually wait till everything settles down. So, well, they get in maybe 3 or 4 years later. So basically, even if the next year the market was up 20%, that doesn't mean average investor made 20%, because they were still so cautious and scared actually getting back. So this is a good one, I think, for every trader and investor to know, that it's important to know that, because we talk about S&P 500, there's always a bias to the upside, to the bulls, than the bears. And what I mean by that is, in average trading day, the markets are up 55% of the time and down 45% of the time. So it might not mean much, but when you look at days in a row, the bias is to the up. So generally, it's better if you're trading to be on the positive side. On the other hand, most of the people made their money when the markets dropped hard, because that, when people are scared, everybody wants to get out. So there are big drops. That's when the most billionaires are made, when there's crashes. But if you're an average investor, you want to investing in the markets, generally it's a good idea to buy rather than sell. So because again, there's a 55% statistically that the markets are up, and there's a good reason for that. So you think about any investment firm, any financial advisor, investment advisor, they make their money being in the market. They get management fee. They used to be commissions, obviously, in the past. So how do you make commissions? By buying something. So if the markets keep going down, who's going to buy? So there's this artificial interest in the markets to actually go up to lure in the investors. I don't know if that makes sense, but it's that, again, it's that the nature of the market. So if I am a company and I'm an analyst, well, obviously I want to be on the good side of the company. I want to be positive about it. So we want to write good articles about that company, or we want to do good analysis. So again, the bias is to the upside, and it's a human nature, especially like in the United States, this go-getting attitude. Of course, we have a lot of self-growth and all that, self-growth, there's conferences and all those books, and people love success. So success is not about things going down, it's about going up. So there is this bias that the markets generally go up. When I say generally, it's like 55%. It might not big, but that's 10% gap, or I would say 20% gap, in the sense that the markets, so they have the biases to the upside. So that's just statistically, I just thought it's important. The other important thing for long-term investors, again, that's why it's good for our younger generation, or any generation, to start as early as possible, is that the stock market has always made profit, has been up over 10 years, 10-year period. So if I started at A and bought the market, 10 years later, it's been 100% that my investment will be up. So we call those rolling 10 years. So if you're willing to be patient and stay in the market, generally, especially in S&P 500, NASDAQ, it took like 15, 16 years to break even. But when it comes to S&P 500, it is a good chance that in 10 years, and this has been since 1955, every 10 years since 1955, you would have been up in the markets. So it's that patience that we have to um, think about. That it's important to know that why it is important to be uh, invested in stock market part of your portfolio, especially if you have like a retirement. In the United States, you have 401ks, individual retirement accounts, Roth IRAs. Those are the ones that, um, they are part of that. Um, so as far as when we think about in 2007, I go back, about 65% of the adults, they had investments in the stock market, and that was pretty high. In average, we have about 60%, although it went down to 52% of every individual, adult individual, had some type of exposure to the stock market. So that's also important, that we've come from a long way when it comes from 1930s, 1940s, 1950s. it it's getting more acceptable. So it's not just these affluent investors who basically control the market. uh, so this is another eye-opening. Believe it or not, right now over 90% of all the stock trades are done by robots. There's not the individual investor. It's that we call them algos or algorithm or algorithmic. So when you think about Goldman Sachs of the world, when you think about JP Morgan or Citibank or Merrill Lynch, they have a unit, and even especially in like options trading and any type of trading, these computers are the ones who are busy making all the trades. And that's why we see, we will discuss it perhaps in the future. We will be, it is part of our 100 shades of prosperity. We'll talk about technical analysis, the technical analysis, like looking at the charts. And that's why you get these specific zones or the points that you see the markets all of a sudden turn around for no reason. There's no fundamental news coming out. So all of a sudden the market is moving up, hits a point, a target, and then it reverses. Well, the reason is these programs have been programmed, these algorithms or the computers. That's their job. So they know they have specific points, and that's what we do as a technicians to find out where they are, and we follow, of course, where the money is, because there's billions and trillions of dollars being invested every day or traded. So the idea is by end of 2029, we probably will have about 99% of all the trades will be algorithmic. And of course, you hear a lot about artificial intelligence now, and that. So the robotic and the robots are the ones, or the computers are the ones who control the markets in a sense.
Whoa.
Yeah. So human beings, as much as we talk about, so,
Makes me kind of feel like, well, I'll just give you a little break here too, so you can
yeah,
gather your thoughts. But um, it's like eventually you'll be, well, you can do it now. Sit in a car and not put your foot on the gas and not even steer the car.
yeah,
And when it gets gonna hit something, it stops. And after there's a part of me that goes, is that like a dumbing down process? Is that I don't have to think about anything, or so that's what triggered for me when you talked about 90% is done now by robots. The old word robots equals artificial intelligence, as far as I'm concerned, same thing,
yeah.
right?
I mean, that should be a session on its own. We also
Yeah,
get to ethical issues, right? The
right.
morality issues, and you're absolutely right. If our organs are not being used, what will happen? And that's the evolution, right? But could it be devolution in a sense? And it is an important factor, um, in a sense of, like you absolutely mentioned, it was. God, what was that name of the movie? Eli. It was about the world had ended, and there was this.
Yes.
So you could see everyone just doing nothing, enjoying, like, they're in the spaceship. And would that happen when everything is provided and we don't have to think, we don't have to think about the food is provided, we don't have to, entertainment is there. And so that's a subject that we have to think about. I still think the human being is the way God has made it, our brain, still behind this. So I'm hoping from the morality issue we'll stick with it. But you're right. I mean, that's what all the computers do, the decision making now. We call them, like, there's a system trading. You just program it and just let it go. But at the end of the day, they still, all these targets, other things are programmed by human being.
That's right.
There's that behavior finance we talked about, the biases still play a role. And that's the reason, and I've argued about this, we have bubbles. I mean, if they were so smart, they will be ahead of the game. We won't have bubbles all of a sudden, markets dropping 80% or 50% and 40%. So they're not as smart as they think they are. So it's always a reaction because of the human psychology. That's why we have these reactions, because, I don't know if I've mentioned it, there's an old saying, the markets take the escalators up, but they take the elevator down. So when things go down, they go down very fast, because when we have fear overtaking our emotions, we don't think. It's our instinct, right? So if I'm losing, get me out of here. I'm calling, and so when we are losing, that's why we have this big crash. And the programmers or the computer program, they cannot do anything. They just go with the flow. So it's okay, we can make it, but that's what is my cautious conservative side. I'm always hedging, in a sense. Make the money, always take some profits, always be watchful, because what will happen, the worst case scenario. So we have that, but also if you have a long-term horizon, and that's what, again, advantage of starting investing at a young age. If you're not really depending on that money, it's more for the retirement. These hiccups over the long run becomes hiccups, but in the short run, I think there was a episode, I don't know if you, I mean, the 20 not 20 in the CBS, like 60 Minutes, they did the episode, in 2008, 2009, people who lost their retirement, because in 1 year, when you lose almost 40% of your account, what do? If you were retiring on that year, you lost 40% of your portfolio. You were counting on to live the next 20, 30 years on that money. So that's another reason about really looking at financial planning. When you're doing your retirement planning, look at the overall asset allocation. So as we get closer to our retirement years, we want to be really conservative. We want to get into more, really, again, conservative investments, more guaranteed investments, because things like this can happen anytime. So I think that's when you will be good to have either a lot of education or have an advisor who is really knowledgeable to manage it for you. So it's not about just making money all the way, but how to manage that money. And I think the biggest failure I see, not only in individuals or families or marriages and businesses, but in the communities and in the countries, is the mismanagement of the funds. Everybody, some people are great in making money, but they fail on holding on to that money, and they don't know how to manage that. So I think that's where it's important to learn the tools, how to keep that money. And that's when you think about Warren Buffett's of the world, how they have succeeded, it wasn't just getting into the right stock all the time. It was knowing the right time to spread it out and do something different with it. So
Right. That's another whole show,
that is, I know.
money management.
Absolutely.
Oh my gosh.
Absolutely.
Yes.
All right, so I'm gonna move to talking about investors. So we're gonna talk about the demographics now, and will be interesting. These are the statistics from 2022, so it's about a year old, because we don't have statistics for today, but it's close enough. In the United States, so this study was in the United States. So there 21% of women have individual taxable accounts. So I'm not talking about retirement accounts, but individual that they actually looking at more of a, well, this long term, they still have to pay taxes on it. So it's more of a, I can use that money to buy a house, or do I want to for college education? So the women are 21%, men are 24%. So you can see again, there's more men with the investment accounts. Now, as far as the married couples, 46% of married couples without children, they have investment accounts. But only 36% of married couples with children have investment accounts. So do you see that gap? Obviously, the responsibility comes into the picture. So they're taking less risk. So if your individuals don't, or if the married couples don't have children, almost half of them have um, they have investment accounts. And as far as the singles go, there's the males. 27% of the males, single males, they actually have accounts. They have no dependents. So to compare with that, 23% of the females without dependents, single females, they have investment accounts. Now, the funny thing is, when we come down, the lowest number is 15% of the single females with dependents have investment accounts.
Oh,
So
wow.
we go from 46% married couples with no dependents to 15% single females with dependents. And that, again, is the responsibility. Of course, you have a dependent, you cannot take a lot of risk. So, but it's interesting to have 15%. Now, this is something that has been a subject for many stories, movies, articles. 10% of Americans, they control 84% of the stock market. So in
Wow.
America, you see that 1%ers. So yeah, so that's the money still, majority of the money is in the big hands. So um, as far as the wealth goes, when we think about who invests, again, with the generations, it's interesting that the millennials are more cautious. They're only 22% of millennials have their money in the stock market. On the other hand, Gen Xers, they have 29%. Now, the baby boomers, which I'm part of that, they have 39%. But the silent generations, it's not like World War II and before, they actually have 53% in stock market,
Wow.
which is very interesting. This is the generation
Yeah.
before the baby boomers. Again, they were born right after the World War II, and that. So it was a good days actually. And remember, the majority of wealth of United States is in the hands of this generation, and they're the ones who are retired. So, but they do have the understanding of the markets, and again, they were born that, so they were raised in the 50s, 60s. They've seen the good times. So um, I'm going to give you some, as I said, we talked about Amazon, Apple and Google of the world, the Facebook of the world, and they're just much bigger than any other country, actually. They could be country by themselves. Many of these companies could be in the top countries of the world. So that's again applying to the markets. And the last but not least, again, as I mentioned, in the United States this year specifically, when you think about the power of the top 5 to 7 companies, they up to like June, they basically almost 100% of the return of the markets came from these mainly 7 companies. So when you think about uh, Apple, you think about Amazon, you think about Meta, or the used to be Facebook, Microsoft, Google, and then we can think about Nvidia, for instance. And these companies basically were the ones who gave all the return of the markets. Now, last 2 months, we have more companies coming up. But imagine, again, if somebody had their portfolio just on these, they could be up about 40, 50%, believe it or not, just for this year. So basically, that's a little fun facts I thought to share with you. Hopefully, that gives you a little better understanding of how the markets work, how they, and stock markets, how they're related to our behavior again, and but also the power, why people are really attracted to invest in the stocks, and why we have again we had the roaring 20s and 1920s, and it was at that time there was again the money was making money, everybody got involved in the stock market, they were leveraging, they were borrowing, and it's the greatest fool's theory. Everybody was buying till you hit the top, and then just things collapse, and that's what we had the 1929 crash, which obviously we had the Great Depression, and but that's the attraction. That's it, again, that's the reason people want to be involved with the stocks, because of all these the returns. I mean, an average. The yield. Oh, I think I have to share something else with you. Oh, I got actually more. Sorry, I was just going to say, as far as uh, yeah, I got the best stock returns. I have to share this with you. If we go back to 1900, so this takes about from 1900 to 2019. So this is going to be a little trivia. Well, we talked about United States, but what do you think is the best stock market based on after inflation? We call them a real annualized return. What would be the best country, you think?
I wouldn't have any idea about that.
Okay. Well, believe it or not, Australia has had the
Oh,
best
wow.
return. They were up 6.8% after inflation, or real rate, in average every year. So that means you had your purchasing power plus 6.8%. United States is the second at 6.5%. South Africa is number three at 6.4%.
Wow.
New Zealand is at 6.4%. Denmark is at 5.8. Sweden is at 5.7. And Canada is number seven. Is at 5.5%. Then we have Finland, Switzerland, and Netherlands. So this is for almost 120 years. These are and that's the reason, again, people want to invest in stocks for the long term. So I thought that was interesting to know. As far as I give you a little more statistic, I think the time is, as long as you have a few more minutes, I just tell you, we talked about crashes,
Hmm.
and I'm going to go to the extremes. Now, the worst stock market year that we've had, I mean, we think about 1929, but 1931, the markets dropped 47% in the United States in 1 year. So that's the worst stock market. And then in 1937, we were down the same. It's interesting. 1937 and 2008 were the next two worst ones at 38 and a half.
Oh, wow.
So it's amazing how almost 70 years later we had this big drop. And then 1974, we had 29.7, almost 30%. That was, again, we've had in 1974, we had double whammy. We had the impeachment, and then almost we had the oil embargoes, and that went hand in hand. And 1930 was 28%. So 1930s, you can see why they dropped. So it was the worst decade because of Great Depression. Um, Now, as far as on the again another statistics, if you want to, because I love probabilities and statistics, we get every 1.5 year we get a 5% drop in one day. So So we get these big drops, but it occurs every 1.5 years. And we've had a 10% drop every 2 years. So if for 2 years, for instance, we haven't had a 2% drop, I mean, a 10% drop, then statistically you can prepare yourself. And that's how we look at the probabilities. And then our bear markets usually happen every 7 years. So that's an average. So let's see what else. Oh, let's talk about economy. We have recessions. So generally, in past 100 years, we've had 18 recessions, which happens about 5.5 years. The only problem is because of the central banks being so proactive, that means they're controlling the money funnel. And in the past 20 years, we've only had two major recession. Now it's like the third one happened. But generally, it's gotten prolonged because of, again, governments interfering. And that has been my big discussion. And my hope is, at the end of every darkness, the tunnel, there's always light. And I've been working on this theory. I'm hoping we go back to this normalization, because markets, they need to grow organically. You don't need outside help, which that has been happening, again, especially in the past 20 plus years, with the Fed and central banks pumping the money, then they taking the money, they put the interest rates down to zero, then they lift it and raise it. So I'm hoping once we have this natural organic journey, it's a lot easier to predict. Recessions are not easy, but that's part of the nature. I mean, it's almost like, again, when you talk about nutritional size, I mean, we cannot just feed ourselves and then just go on complete diet. And we want to have this nice ebbs and flows, but it's more predictable. And we haven't had that. And because of that, there's these artificial movements in the markets. So it makes it difficult to really see what the nature is going to take. But I'm hoping, I think, with what has happened in the past 3 years, we will get back to normalcy. It's okay to have recessions every 5 years. I know it's difficult, but it is part of again, the natural course. So it's okay to have that, and then we can build on that. But now it's been so artificial; you don't know when it's going to happen, and then the government decides. So I just want to share that with you because it is important, and that's the reason the financial crises happen more often now, because of it used to be every 38 years, and now imagine we have 3 of them. Not one is not, we have no control, but we had the internet bubble in the 2001. We had the financial real estate crisis. It happened just a few years later, 2008, 2009, and then we had the COVID crisis. So in past 20 years, rather than every 38 years, we've had like 3 of them in past 21, 22 years. So
wow, yeah.
Anyway, I just thought to share that with you. I hope that was helpful, and was something.
Well, I would like to do a little summary and conclusion, if you will.
Please.
That's one of our favorite terms.
Sure.
I have taken 4 pages of notes during this chat here. Sometimes it's important just to listen, right? So that's what I did today. And I have 4 pages of notes, and I'm totally, what I knew about stocks when I came into the show today, we could put in a thimble. But now I think we could put it into something bigger than that, but then that takes us back to our projects and education. I'm an educated individual, but I have never played the stock market, ever. I have friends who have, but they didn't tell me anything, right? So it's like a lack of education. So that's what you and I are all about, is providing education in the areas of health and wealth, because without that, we live life minimally. We don't get the biggest bang for our buck, so to speak, and we all need to know how to do that. So, thank you, thank you, thank you, thank you. And I am going to send the show to a few people that I want to inspire to step up and educate themselves in what it is that we want to bring to the table. And that information that you just shared, I can't even put a price tag on that
Mm.
at all, because it's not just about what might inspire me to do more of and grow my money, but all of the other people out there who need to hear you speak on this. And this is why you are so invaluable in terms of talking about an area that traditionally in my generation, I'm a baby boomer also, was taboo. We weren't allowed to talk about money. We didn't know how much dad would bring home. We weren't allowed to ask, what did something cost? Like what did you and dad pay for the house? These were questions that were considered inappropriate. So traditionally and generationally, the baby boomers particularly, we grew up in prosperous times, the 50s and the 60s, but we had no idea why or how or anything. And we always thought that's the way it was always going to be. That was another thing. And when I turned about 12, my dad was an accountant also, and he had a very good job with a big steel company. And no credit to him, but the company went under. He was just the bean counter and paid payroll clerk, and then all of a sudden, we're struggling, and we had no idea about struggle. You know how some people go from rags to riches? Well, we sort of went from riches to rags. And to tell you the truth, I don't think my parents ever recovered from that totally financially, or even more importantly, emotionally.
Yeah.
My dad never recovered from that, I don't think.
Yeah.
And it was like that when you talk about that snake bite. So then, when he got back into the workforce, he was so grateful to have a job. That ambitious side of him was not really there anymore. Yeah. I could just see the pattern there in my own world, my own upbringing. And we were not allowed to talk about money or sex. So I think we should actually do a show, uh, and call it, I think I shared this with you, call it taboo, and just the only things we're going to talk about are sex and money. Because the great sex therapist, Sue Johansson, Canadian, passed away a couple of weeks ago. So who's left? And then Larry King is gone, and Barbara Walters, and any other financial guru that was out there doesn't do it the way you do it. I've had a lot of people give me advice about what to do with my money, but I probably learned more in the last hour than I ever did from any financially person who was supposed to be guiding and directing me.
Hmm.
Yeah. So thank you for
My
showing up
pleasure.
and shining. And what are we going to talk about next week? You already have a plan.
Yes, so I thought talking about again the behavior. It's such an important thing. Is you just mentioned from rags to riches and then riches to rags. Well, we're gonna come up with that theme. I've worked with a lot of professional athletes and some in entertainment business, and again, they've come from the rags to riches. They've been very successful at what they did. They were brilliant, and but yet when it comes to finances, it's not their cup of tea, or they think they know much. They take a lot of risks, and a lot of them they go bankrupt, although they've made millions and millions. And I mean, when you think about Mike Tyson, we're talking about 300 million. How can you lose $300 million? I mean, it. We just have to have a show, just a movie about how to lose $300 million. But
Right.
I've seen it with my own eyes. So I thought it would be interesting to see why it happens, and it applies to our own actually lives too. I mean, you've been many times you have mentioned about lottery, for instance, why it happens. And it, again, I think we can tie in our biases, our upbringing, our money beliefs, and also, again, the lack of the right guidance. When your
Right.
cousin who has never done anything in finance and comes and gives you this brilliant idea of owning this great restaurant or buying this, I don't know, in gold investments, or this pyramid or whatever it is, and you go along with it, well, you got to do your own due diligence, and that's the
Yeah,
other thing. So it's important. But I thought that might be interesting to just
that'll
use some
be
other
great.
athletes or
That's,
entertainers. So that's for next week.
I can't wait. I can't wait to be here next week.
Okay.
All right. Well, we better wrap up here. And I just want to thank Ramin for joining us again today on
Sure.
Tuesday, Money Matters. And I've kind of given it that little bit of a title, Money Matters on Tuesday. And so thank you for that. We're streaming live right now on YouTube, Laurie Davis, show host, E360 TV, of course, and they're archived here in these places so you can come in and watch later. I would advise someone to probably watch this show at least 3 or 4 times to get all of your notes in order. And of course, streaming live right now on Self-Worth, the Missing Link Superstars. So I'm going to, when we're done, I have a couple of appointments, but I'm going to be sharing the show later today. And thank you so much again for all of your information, Ramin. And everybody have a great day. Bye for
Thank
now.
you. Bye now. Enjoy.